Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today for this third and final segment of the show. If you missed the first two segments, you missed a great one. We had John Jertson from the office, an advisor in our office, here talking about IRAs, traditional IRAs, Roth IRAs. You know, which one is better? Which one should I do? And of course, with a lot of things we do in planning and investing is it depends. And with the tax code changing all the time, the rules for retirement plans changing all the time, it's an area that you can really sort of win the game, as John alluded to, but you might need some help. And so, you know, we're here to help you. If you've got questions on IRAs, please give us a call. I mean, the one thing we didn't touch on very much either was, you know, the 401k. John mentioned you want to max that out, especially, maybe not max it out depending on your planning, but at least take any match that may be available. And if you're self-employed, it opens up a whole host of other retirement plans. The solo 401k is where you have just a husband or a husband and wife that own a business, is one of the best kept secrets out there for retirement planning. You can put away an absolute ton of money if you have a profitable small business. Speaking of which, I wanted to segue into something we briefly mentioned last time, I believe. But in 2012, the North Carolina legislature, for those of you that don't live in North Carolina, maybe write your congressman or senator if you're in a tax state. Now, if you're in Florida or Texas, no tax state, or Tennessee or wherever, you know, here in North Carolina, we're trying to catch up to you guys. And so this was a good start. I just wanted to kind of expound on this new active business tax deduction. And what it is in North Carolina starting in 2012, an individual that owns a business where they earn active income, and we'll talk about active versus passive in a minute, but where you earn active income, you can deduct $50,000 from your income. If a husband and wife are both active in a business, or one owns one business and one owns another, you can deduct up to $100,000 of income. And this is a tremendous benefit for small business in North Carolina. And I applaud the legislature for taking this step and recognizing that small businesses are very vital to the economy of North Carolina, and that the taxes, increased tax rates hurt small business owners disproportionately. So this, what I want to talk about here is a little bit of the rules. A lot of questions. One of the most confusing areas of the tax code is active versus passive and material participation and things like that, especially when it comes to real estate. So let's say you own a, I don't know, a dry cleaner, and you earn $75,000. You own it 100%. It's yours. You're a sole proprietor. You file a Schedule C. You can deduct $50,000 from your income if you materially participate in that business. And what is material participation? Well, there's some complicated rules that the IRS lays out. Like everything, it can't be that simple. There's 7 very specific rules about number of hours worked and things like that. Suffice to say, if you go to that dry cleaners every day and you're there supervising and working, putting in 40 hours a week, you're an active participant. You can deduct $50,000 of that business income. Let's say that with some planning, and you came to someone like us and we recommended that you set up an LLC or a S corporation or something like that to run your business, and your wife owns 50%. And let's say that she also, on a regular basis, shows up and does the work and helps out in that company. For an LLC, you could deduct $100,000. The rules for if you're an LLC or an S corporation are a little bit different. It gets a little tricky. If you're an S corporation, the way the tax code reads currently is that a husband and wife own business, that material participation, if one spouse materially participates, then the other is considered to materially participate. So in that particular scenario, if the wife works there at the business all day long, but the husband doesn't, well, you can still take the $100,000 deduction because they're both considered to materially participate. When it comes to rental real estate is considered a passive activity. So if you own rental properties, and whether you manage them yourself or you hire a management company, the very act of renting real estate is considered a passive activity under the code. Now, there are certain things that come in if you materially participate in that activity. I don't want to get into that today, but for the purposes of this North Carolina tax deduction, it has to be active participation. The only way that rental property is considered an active business is if you qualify under what's called the real estate professional qualification. And to do that, and I'll read this directly for you, more than half the personal services that you perform in all trades or businesses during the year were performed in real property trades or businesses in which the taxpayer materially participated. So let's break that down. And then the second qualification is that you have to perform more than 750 hours of services in real property. So if you didn't perform more than 750 hours of service in real property business during the year, you cannot meet the real estate professional qualification. Typically what we see is we'll see a realtor that is selling real estate and also owns some rental property. Typically those are the people that we see that have an easier time meeting this real estate professional exception. So more than half your time has to be spent on real property. So if you have a full-time job and you tell the IRS, well, I'm a real estate professional, you're going to have a hard time making that argument, because you have to work more than 750 hours in real estate trades, and then, the average work year is 2,080 years. So that's a significant amount of time. It's very difficult to make that argument. The second qualification is your participation has to be material, and that means that you have to have an active role in participating. Well, those are some confusing rules. If you have any questions on that, please give us a call. One of my expertise is real estate, investing in real estate, the taxation of real estate. But this is a great deduction that the North Carolina legislature has come out with. So if you don't know what I'm talking about, or your CPA didn't mention it, please give us a call and we'll help you get you straight. Well, that's about all the time we have for today. Hope you enjoyed the show. I think it was a great one, and that you'll tune in the same time again next week. So for All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.